We have Ashwini Agarwal, who's the founder of Demeter Advisors, joining us on the show. A very good morning to you, Mr. Agarwal. Thank you so much for joining us on ET Now. And the first question, the most important question, year 2024 is towards its close. What should one expect when you talk about the year 2025? Do you think this one also will be with lot of volatility and ups and downs? Because when you started the year 2024, you expected it to be as healthy as the previous 2 years were.
So thank you for having me on your show. 2025 is going to be a very interesting year because, you're entering the year with in the backdrop of significant global changes in terms of political leadership, in terms of how trade globally is expected to work. There's going to be a lot of upending. Let's see if it turns out to be more disruptive than people are already bracing for or not. Closer home in India, we'll probably see a turn in the interest rate cycle after a couple of years, hopefully, and we'll also see, earnings sort of picking up a little bit of a pace in second half as compared to the first half of this financial year. And then we have to see whether the investment demand picks up adequately or not, because that's been lagging for the last 1 year or so, especially on the government side. So it's going to be a very interesting year. Let's see how it turns out.
Okay, Mr. Agarwal, this is Snehi also joining in the conversation, and festive greetings to you and wishing you a very happy new year as well. But while we are just around the corner to celebrating the new year, give us a sense of what the broader markets are expected to do going ahead. They have outperformed the benchmarks, and recently we've also seen a trend that every time the market is looking a little shaky, you have either the mid cap or the small cap that are saving the day for the markets on an overall basis. Give us a sense of what the broader markets are expected to do going ahead, and do you believe this kind of 20-25% rally that we've seen across both mid cap and small caps continuing for next year as well?
Very interesting question, and what's happening in the broader market is more a determinant of what flows are coming into the market and from whom. So if you think about it, 2024 has been a year when you've seen not much support from foreign institutions, but there has been a significant amount of inflow from domestic retail and directly into the market. Now that tends to be a little more bottom up, little more stock specific, little more determined by recommendations that work on a hearsay basis, etc. And that's been very good for the small caps. The small and mid caps are also trading at valuations which are significantly ahead of large caps, because large cap stocks haven't done as well, like you said. We are up 10% on the Nifty versus say 25% on the small and mids. So I think that level of outperformance is difficult to sustain over longer periods of time. Small caps, mid caps, large caps, they all converge. So I think the starting point of valuations is very high. So you can't expect that kind of outperformance to sustain. Also, my personal view is that there's a massive supply of paper that's coming into the market via IPOs, via offers for sale, and so on. And I think that will necessitate some breathing, some absorption capacity of the market. It will test the absorption capacity of the market, and in that context, I think it's going to be very hard for the broader market to continue to outperform the narrow frontline market indices.
Right. Mr. Agarwal, I wanted to understand your take when you talk about the metal space, because, the last 3 to 4 months, the action or the renewed focus has actually been on the entire metal space, owing to what everyone's been expecting that the Chinese government would do, be it the stimulus or the fact that to pump up the economy. But that's not the way how it's transpiring. I think a lot of optimism was built around it, but that's not the way how it is actually transpiring when you talk about the Chinese government moves or the economy. What's your take when you talk about the metal space? Should you look at that in isolation of what's happening in the Chinese government or the Chinese government move, which is very difficult to do otherwise, because given the fact that they are the largest consumers in the world and the producers?
Yes, that's right. Interesting question. So let's divide it into buckets. I think when you look at metals, first is steel. Steel, there's been a lot of discussion around imposition of a 25% import duty, especially to protect against cheaper Chinese imports. Personally, I'm not in favor of this kind of intervention, but if the powers that we decide to do so, you'll probably have a positive outlook for steel companies. Your EBITDA per ton, which is currently quite depressed, will expand as a result of this protection. Coming to other base materials, whether it's aluminum or the others, I think there's a lot of pessimism that's already set in. And I don't think you'll see meaningful deterioration in outlook for other metal stock from where you are. Whether you'll see a rebound or not is very difficult to call. It's also a function of how the dollar behaves in response to unorthodox policies followed by the US, if at all, and what happens to dollar-denominated prices of these metals. I personally stay away from base metals because these are global variables with far too many drivers, just not supply and demand. Even if it were possible to analyze demand and supply on a global basis, which is not easy at all. But outside of that, there are several other factors, and I prefer to stay away from this sector on the whole.
Okay, not looking very optimistic when it comes to the metal space. Mr. Agarwal also gave us an outlook of what you are making of the pharma space going ahead. It's been a strong defensive for 2024, second highest sectoral gainer and very close to the first one, that's been Nifty Realty. Give us a sense of what you're making for pharma headed into next year. And if you had to play this theme, would it be via healthcare, would it be via diagnostics or pure play pharma companies?
My preferred space within the healthcare space is the hospital's healthcare space, because I think there, you have significant drivers for long-term growth in this country, and you have industry consolidation also playing as a theme. So I think that will continue to do well, and valuations are okay; they are not very, very stretched. The other place I would play it is upstream pharma, the API and the intermediate space, because that's where the margins got compressed over the last 2 years. In a post-COVID, reshuffle where there were excess inventories created in the system, and some of the companies had to contend with high raw material prices as COVID wound down. So a lot of the compression in margins that you've seen over the last 2 years will come back to normal. So those are the two spaces I would play it with. I think on a broader basis, the realignment of margins to long-term averages is also palpable in the specialty chemical space, which is similar to upstream pharma or the API pharma space or the intermediate space, and that would be another place that one can find some ideas.
All right, so that's the take coming in on the pharma. Ashwini, Mr. Agarwal, sorry, I wanted to understand your view coming in the banking space, because this one has always been, I think the maximum of the market participants, I'm not sure if you're also one of them, have been cheerleader for the entire banking space, saying no matter what, this sector will perform well, will lead the market higher going ahead. And one of the biggest names that everyone talks about is the HDFC Bank. And year after year, whenever you ask what is your bet for the next year, it will be HDFC Bank has to feature in that list. But that's not the way how it's transpired, right? For the last 2 to 3 years, this one has not moved. No doubt the weight of this one in the banking index is pretty high. So even a percent move makes a huge difference. But what's your take on the banking index as a whole? Not talking about stock specific, but what's your take now? Do you think that the year 2025, again, you will place your bets on the banking sector and this time it will perform?
So there are two aspects to it. What is happening fundamentally to banking earnings and what is happening to flows. Now, if you think about it, the large cap banks is where a lot of foreign investors have invested in, since inception. So it's the largest sector in the MSCI indices, and it's very well owned. So in a year like 2024, where foreign investors were largely on the sidelines or were net sellers episodically, you can't expect the banking sector or the banking indices to do so well. In addition to that, if you look down the cap curve in the banking sector, you had issues relating to credit cards, you had issues relating to rising defaults in personal unsecured borrowing space, so that also hurt. 2025, you'll see normalization of credit growth coming in line with deposit growth. And hopefully, as the interest rate cycle turns, which is what I had said in my initial opening comments, you'll see a very benign earnings environment for the banking system. But again, technical factors like who's buying, who's selling will play a big role. Large banks will be driven by foreign institutional activity, whereas the smaller banks and microfinance and so on might get driven by local flows and by bottom-up themes as they emerge.
Okay, Mr. Agarwal, thanks for that view coming in. Just want to get a quick take from you heading into next year. Do you believe it's going to be a year of defensives, or do you think the cyclicals will be taking over? And if you are liking something from the cyclical space right now, other than your usual defensives, just give us a sense of what's looking attractive on that front as well.
So, my sense is that sectorally, it's very hard to make broad brush recommendations because, by and large, stock prices are very well discovered. So banking and finance is one space, healthcare and pharma is another space. Normalization of margins in a post-COVID slump of margins for midstream pharma or for specialty chemicals is another space. So, those are some of the spaces that I'm looking at. Otherwise, it's more bottom up. I think you will continue to see interesting opportunities in the market, stocks that have lagged and where earnings are normalizing. That kind of a theme will play out on a stock-specific basis in 2025. But broadly, it's going to be a very challenging year because I don't expect significant returns at the index level in 2025, given how strong returns have been over the last few years and the fact that earning growth has slowed down. So to that extent, to expect the markets to do very well again in 25 is going to be a very difficult task.
Well, have you figured out which sort of theme would work for the new year, given the fact that this year we saw a lot of new themes emerging, or rather we saw a lot of new themes re-emerging, because you had, I think for post-October, we did speak about the CDMO space when you talk about the pharma industry. Then you had the solar, the renewable energy space where everyone's talking about. Do you think these themes will continue as the favored bets in the year 2025, or are there some new themes that you are looking at or you would want to look at, given the fact that you will have some renewed focus on them?
It's a very difficult question to answer because, the fads, they change, from quarter to quarter. I prefer to look at, more sustainable earnings drivers and what's happening in the long run and the starting point of valuations. So some of the themes that you spoke about have already become so expensive that it's hard to imagine that those themes will continue to make you extraordinary returns in the coming year. At the same time, there are several places where valuations are completely crushed and earnings outlook is extremely poor. Microfinance, for example. Now, whether we have another couple of quarters of pain or we have another couple of years of pain is very hard to tell at this point in time. But, if one can make, some judgment around those variables, that might be a space that might do very well, by when we are speaking, 1 year down the line. So it's very difficult to say what theme is exactly going to play. I think it's going to be a very volatile year, like you said earlier, and it's going to be, very bottom-up specific. So outside of the three things that I've highlighted, I find it very difficult to anticipate what themes will do well this year.
Okay, so that's the take coming in on the themes. Mr. Agarwal, just on a lighter note, you did say that we're heading in for a volatile year for 2025. A year like this, are you expecting a single-digit return on the Nifty, or do you think we could expect to see some double-digit gains?
Well, if I could tell that, I'd bet all my money on that view. It's not possible. That level of forecasting is impossible to do. There are far too many variables at work, especially in a year like 2025, where there's going to be very unorthodox leadership in the United States. Large parts of the world are still struggling to grow. India is growing in that respect, but your starting point of valuations in several places are extremely expensive. I think it's a very difficult call to say whether you'll see single-digit returns or double-digit returns or negative 10% returns also. I think I'm bracing for a flat to a no return 2025, if you were to ask me, but there's no confidence in that outlook.
Okay, and also I want to get your sense on what the one of the biggest themes that we've seen this year has been the entire frenzy surrounding quick commerce. You have all your traditional retail players that are now pivoting towards quick commerce. Do you believe that this initial frenzy that we've seen around this entire space can continue into next year as well? Because also we have another player who's going to be entering the listed space when it comes to quick commerce. And on the back of this, what do you think is going to happen to the traditional big box retailers?
So, the disruption being caused by quick commerce is real. And, that's the order of the day. I mean, when supermarkets came up, there was a certain change in the playing field available to traditional mom and pop retailers. And then, you had big box retailers coming in that changed the pitch for the others. So, this kind of a reset that quick commerce has done is frankly going to stay. There is an immense level of value that people find in quick commerce. Especially in a country like India, where it's congested, it's difficult to go out, park your car or park your bike, and buy something. It's much easier to get the delivery at home. And even if quick commerce starts charging a little bit more, overall the convenience factor is so high that this is a business that will continue to grow. Having said this, the starting point of valuations are quite stretched. So whether you'll make money on the stocks or not is very difficult to say. I mean, it's like IT, right? Between 2000 and 2025, IT companies have grown multiple fold in size and the stocks have done well. But because the starting point of valuations in 2000 was so high, you didn't make any money in any IT name for the next 7 or 8 years. So, whether you'll make money on the stock or not is different. But whether these companies will do well, the answer is an emphatic yes. So that's how I look at it, and I think what it means for traditional big box retailers or for mom and pop retailers is that this is another competitor on the horizon, and you have to kind of adjust to that. I mean, that's the evolution of retail as we've seen it over the last 3 or 5 decades.
Mr. Agarwal, and lastly, I believe we've asked you a lot of tough questions for today, but as we actually wind down for the year 2024, we step into the year 2025. Firstly, I want to wish you a very happy new year to your entire team. But apart from that, one last question that I have is the fact that we've spoken about a lot of themes that you are looking out for or which you may have on your radar. Which is the one sector for now you think in the year 2025 you would not want to give a relook at?
Well, I'm biased towards value. So anything that has very high starting point of valuations, frankly, doesn't appeal to me. So whether it's defense companies, whether it's outsourced manufacturing, whether it's solar, I mean, the so-called fads of the last few years, frankly, the starting point in valuations is so high that the likelihood of making any decent returns on these stocks on a multi-year basis is quite low. So those are the places that I would stay out of. I think the single biggest determinant for making money or losing money is the starting point of valuations, and I keep that on my horizon at all times.
Okay, on that note, Mr. Agarwal, it's been a pleasure speaking to you. Thanks for joining us as always.
Thank you.
Once again, festive greetings to you and a happy new year as well.
If you like this video, then like, share and subscribe to ET Now.